Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for yet another quick edition of That's Our Two Satoshis Live. For those who don't know, ARCA's been talking about the digital asset markets for years, almost 6 years now, actually. And we write a blog every week. You can find it on our website, ar.ca/blog, called That's Our Two Satoshis, where we talk about what's going on in the markets. And we come here on Tuesday to talk about it. Before we get started, as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Okay, this one probably pretty short and sweet this week because it's been quiet in the markets. We've probably been talking about that theme for the last 3-4 weeks now about how quiet it is in the market, and nothing has really changed over the last week, with the exception of a little bit of a surge in equities. Sort of important, sort of not important. We'll get into that in a minute. Important in the sense that when all markets do well, obviously that is a benefit to most markets. Not important in the sense that really correlation of digital assets relative to equities, relative to rates, relative to even gold, just kind of back to pre 2022 levels of really no significant correlation. So, maybe a little bit of a risk on sentiment improvement because of the equity move, but not really a direct effect on the digital asset markets themselves. So what did happen last week? You probably noticed on Friday, pretty big move in tech stocks driven by NVIDIA, the world's largest GPU manufacturer, which saw its stock price surge over 25% on Friday after beating earnings and raising Q2 guidance. A lot of it coming from new AI customers, hot button of the day. Everyone loves AI. What's interesting, though, is now you look at the S&P 500. In aggregate, the S&P is up almost 10% now for the year. But the breadth of that has been really not great. If you take the seven largest companies in the S&P, which is Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, they're up about 40% year to date. If you take the rest of the S&P 493, removing those seven, they're only up about 1% year to date. So this is one of the biggest gaps we've ever seen between cap weighted and equal weighted members of the S&P. So again, really driven by just a few companies, a few tech companies, not really all that relevant to the digital asset market. Same thing really with the debt ceiling. We did get resolution over the weekend. President Biden and House Speaker McCarthy did compromise and reach a debt ceiling deal. A pretty low probability tail risk. I'd say almost anyone we talked to assumed this was going to get done. It wasn't really a real risk. At the same time, it was a risk. And anytime you can remove any sort of an overhang whatsoever, it generally is pretty good for markets. I mean, you can go back to the last presidential election when Biden eked out Trump. Obviously, everybody knew there was going to be a president elected, but that little bit of risk that people thought that maybe Trump would not go down quietly if he lost, would argue the results, put a little bit of an overhang on the market. And as soon as we saw that cleared up, we were off to the races in November of 2020. I think the S&P was up 8-9% in a single month, and obviously digital assets did well as well. So anytime you can remove any kind of an overhang, it generally is positive for markets. Now, again, does any of this really matter for digital assets? Not really, right? We've had probably the most lackluster couple of months we've ever seen. Bitcoin, just as a proxy, for example, hasn't posted a daily move of over 6% in over 70 sessions, so almost 3 months now, which is the longest streak of calm since October of 2020. If you look at just overall volatility, we're back to pre 2019 levels across Bitcoin and ETH. And again, when we're talking about correlations, it depends on really when you entered this market. Prior to 2022, one of the things we always talked about with digital assets was that this is an uncorrelated market. It really has no bearing on other markets or vice versa. And that was pretty attractive, especially for institutional investors who were looking to smooth out their portfolios and diversify their portfolios. Of course, 2022 was different. We had the fastest rate hiking cycle in 40 years. Everything was correlated to what the Fed was doing. And that maybe tricks some investors into thinking that Bitcoin and ETH and other digital assets should therefore forever be tied to macro. And the reality is it's just not true. 2022 was a blip. It was an anomaly. And if you look at Bitcoin and ETH and other digital assets correlations now to the dollar and to oil and to 10-year rates and tech and gold, you name it, we're back to 2019, 2020 levels, which is to say there really is not a very significant correlation. So I think what this means going forward is we're going to have to look for real digital asset specific catalysts, negative or positive, to really move us from here. And last week we did see a little bit of that heading in the right direction for those who are invested heavily on the long side of digital assets. For instance, we're seeing ETH staking rates just continue to go higher, up another 60 basis points last week. Started around 13% staking rate before Shanghai upgrade in April. Now we're up to 17.7%. And I think that continues into the 40-50% range over the course of the next, call it 6 to 18 months. You've also seen an interest in meme coins like Pepe, which has driven ETH supply to new lows. Now that ETH is disinflationary and at times deflationary, the supply of ETH is down almost 0.32% now since the merge, which basically, if you believe in any sort of economics, if the demand is constant and supply is lower, price should go higher. So you do have a couple of specific catalysts here with ETH staking and ETH supply, not to mention NFTs, something we haven't talked about in a while here, but certainly something that we feel is a really important pillar for the future of blockchain. Starting to see a little bit of interest again in NFTs. Probably too early to call it a total reverse in the market because we're still trading well below January 2023 numbers. But we are starting to see some collectible projects starting to pivot, some gaming projects, gaming Steam, anything related to AI, especially with art, is doing pretty well here. And we're starting to see the volumes and active traders start to increase here over the last couple of weeks. Again, nothing crazy, but something. And we also have the Three Arrows portfolio. If you look at what 3AC's NFT portfolio, that's being auctioned off by Sotheby's. And it includes one of pieces of NFT art that is viewed as one of the best. This is Ringer number 879, known as the Golden Goose. You can find it on OpenSea or other places. But this will hit the market as well, and it's expected to go for somewhere around $1.5 to $3 million. So even though that's a lot less than what 3AC paid for it, still a pretty strong interest in the NFT space. So if you put it all together, you got a low vol environment with few, if any, macro headwinds now that first quarter earnings and the debt ceiling are behind us. You've got Bitcoin and other assets in the digital asset world being back to completely uncorrelated to other markets. You have certain sectors starting to pop up like AI and liquid staking, as well as NFTs starting to get a little bit of a bump. And of course, as we mentioned, ETH being basically, in my opinion, the most representative asset of all of the digital asset markets, since it covers DeFi and stablecoins and even wrapped Bitcoin as well as NFTs. The tokenomics moving in the right direction with supply dwindling. So, people have been talking about the bear market now for 18 months, and this may be just being another bear market rally. Starting to feel like it might just be a continuation of the bull market. You draw any line for the NASDAQ or for digital assets. And again, 2022 just looks like a blip at this point, not really a trend. So we'll see where that takes us from here. But a little bit of a glimmer of hope for digital asset enthusiasts over the last couple of weeks. And we'll see if that continues heading into the summer. So that's it for this week. Again, all the charts, all the data, everything that we just talked about is in the blog. You can find it on our website, ar.ca/blog. Appreciate all the time and attention. Reach out to me on Twitter @jdorman81 if you have any thoughts or questions. Otherwise, we'll see you again next week. Thanks, everybody.